Taiwanese index trading with gains of around 0.2%, as is the Hang Seng.
The 40-day exponential moving average, which is 25,222.
Chinese policymakers have made it very clear that they are paying attention to their equity market.
Focus of HDFC Bank is on deposit mobilization, and if you take a look, that has been pretty strong for them.
25,211. It's a flattish start, 0.15 lower.
So I think the market continues to be strong.
What we need, obviously, is for property prices to begin to turn up.
It's not that there is a huge inflationary bias for the overall economy.
There's been a phenomenal recovery in the markets in the last 45 minutes or so.
Many analysts have come up and said that money is moving out of India into the Chinese markets.
The Nifty is off around 400 points from the day's high.
Sharpest strategies, top market trends, unmatched perspectives, the trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Well, it's not a good-looking screen at all. It's down. I mean, actually, it was around 250 points nearly now, and on the cusp of breaking 25,000. I mean, just absolute bloodbath once again, like yesterday. This is Closing Bell. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Reema and Surabhi. Guys, hi. Afternoon.
Hi, afternoon, guys. And what a stark contrast, right? We look at our screen, and actually we should do that. Let's try and pull up the rates if we can. And look at Hong Kong once again. 3% of a rally. So Hong Kong paused for all of one day. And then it's that same move playing out. So I guess not something that we're quite used to.
I think the flows once again, perhaps maybe large. Maybe, I don't know if it'll be as large as yesterday. But there you go. That's what Surabhi's talking about. Down, that's Hang Seng in Taiwan, but Hang Seng in India, right? I mean, that's the... a comparison to really kind of make. So, yeah, I mean, and it's been volatile at that. Yesterday, of course, was down and then more down and more down through the course of the day. Today, there were bounces. That bounce right in the middle of the day was substantial, meaningful. We were up 150, and then it basically dropped like a stone. You went down 50 points, and then it accelerated to being now down 200 plus points. So I don't think there's very much point looking at individual names because it's everything down kind of a day. I'm on my screen, 950 stocks are higher and about 1,800 stocks are lower. So it's 2:1 clean, market breadth looking pretty weak as well. Sectorally, maybe just a quick look. Wix, by the way, India Wix is up 8%. That's something to note. And of course, sectorally, real estate is down 2%, the sector. Autos are down 1.4. FMCG is down 1.4. Infrastructure is down 1.2. What is up, I saw, was PSU Banks. PSU Banks and IT. Actually, those are the only two sectors which are up in the green. PSU Bank about 0.7 and IT, which is up 0.5%. Reema.
So now we've reached the 50-day moving average of 25,021 on the Nifty. Earlier in the week, we had breached the 20-day moving average. And now even the 50-day moving average is gone. And we're down for the fifth day in a row. And this week, the Nifty's lost about 4.7%. The mid-cap index is down 3.8%. But, if you look at the FI favorites, historically, it's been IT, it's been some of these large-cap banks. The Nifty IT index is up close to about 0.5%, and the banking index is down 0.4%. So it's under pressure, but it's relatively outperforming the frontline indices. But it's just the way the markets gave up at about 12:30 or so. There was a sudden turn in sentiment, and Europe also, by the way, is still holding up in the green right now.
Yeah.
So not just Hang Seng, but if you pull up a CAC, that's up close to about 0.5%. I think even the DAX had a green tick. It's only FTSE, which is down about 0.25%. But it's not that you're seeing the kind of selling pressure in Europe that you are in India.
Oh, yes, absolutely. And, however much we want to wish it away, this whole take, and I remember this was, I think, Editors Roundtable over a week ago. And that's the question that we were asking to our guests even back then, that will this just become an excuse for foreigners who are already in India to book maybe some profit and start shifting the money around? And maybe we've seen a lot of that play out this week as well. By the way, that's important news as well from a global standpoint. Finally, this was along expected lines and it's come through. 45% tariffs on EVs that are being manufactured in China. It's a sort of big war out there. US anyways, I think, imposed tariffs of up to 100% on China-made EVs, and Europe is following suit. So yeah, the global EV war continues to play out, considering the cost advantage that Chinese electric vehicles, of course, have. Anyway, let's come back to the story here at home, and that continues to be the big fall that we're tracking. So what are the bets for the last hour? We have Ashish Kayal joining in with some thoughts and ideas. Ashish, let's talk about the index first. Now, like Rima pointed out, the 50 DMA obviously is under question. We don't know if we'll even hold 25,000 by the end of trade today. What are the key levels for Nifty, Bank Nifty, and then we'll get to stock trades?
Sure. See, if you look at the overall selling pressure has continued to intensify. Today, there was some kind of an attempt we can see on the upside where the index managed to go towards that 25,400 levels, but it failed and broke below the day's low. So that suggests that the overall mood or momentum is on the downside. Use any pullback from here back towards 25,100 and 25,150 as a selling opportunity. And on the downside, the support is around 24,970. That's below that 25,000 psychological mark where we have a high put right up as well. So in case Nifty breaches that and moves below 24,970 levels, there can be further selling pressure intensified that we can expect. So in a nutshell, the overall trend for Nifty is sell on rise. Pullback can be used as a selling opportunity for the target of 24,980, and if that breaches, then maybe 24,700 on the card is what we can expect.
Okay. What about stocks? What would you recommend, Ashish?
On the stock side, we can look at Exide Industries. We can see that the stock has been managing to buck the trend. And despite of the sell-off we are seeing in the broader market, especially the mid-cap, this stock has managed to outperform. So one can create long position in Exide Industries over short term for the target of around 535, and stop loss of 485 can be maintained. And if 535 is taken out, further higher levels can be expected in Exide Industries. The next stock is going to be on PFC. We can see that PFC has broken below the low, and we can clearly see that it is not able to sustain at the higher level. So it's on the sell side. So PFC, one can create short positions here, maintaining a stop loss on the upside near 475, which is above the day's high, and then expecting a target of somewhere around 440 levels on the downside.
Okay, got it. Ashish, thanks very much. We'll touch base again with some more trading thoughts and ideas. By the way, another important cue to keep in mind is oil. And that's obviously another overhang for our market. Brent has inched up to 78. So the 5% surge happened last night when it was around 77.5 thereabouts. But now it's officially crossed the next threshold, which is 78. So oil prices with another 1% on top of yesterday's 5% surge. That's something to kind of keep in mind as well. Well, with that, let's move on and spend some more time talking about this whole India versus China debate in terms of FPI inflows and outflows. Hormuz has been looking at a lot of data surrounding the kind of selling that we've seen over the last couple of sessions. Hormuz, fill us in.
You know, the highest FII selling in a single trading session in the last 4 years. And this has been one of the major overhangs that the market has seen as a result of the fall that we are witnessing in the markets currently. And if you can see this comparison that comes up on your screen now, the CSI 300, the benchmark Chinese index, before it went for the holiday, the 9 trading sessions that it had starting the 18th of September, it rallied 27%. From a 52-week low, it jumped to a 52-week high, 900 points in 9 sessions before heading into the holiday weekend. Now, in comparison, ever since the Nifty made its record high last Thursday, it's down 4%. Of course, the fall is extended today as well. But that is the comparison that you're seeing, the China outperformance that you have witnessed, and that is the big reason why the FII flows are moving to China. A lot of experts also coming on our channel and speaking about the tactical money moving in. But still, there are a lot of people who are not convinced about this rally in China. Rajiv Jain is one of them of GQG, and he mentioned that there are multiple instances in the last 3 years where they have had this kind of moves, but then these moves have not lasted in the Chinese markets. He said this is a good trading opportunity, yes, but whether it is a 3, 4, 5-year investment opportunity, well, that's a question mark. Citi also came out with a note. They mentioned that this rally has drawn the Chinese benchmarks on par with the Indian benchmarks in terms of returns because of the multiple policy announcements that were made in the Chinese markets. But the macro stability in India, the growth opportunity, and of course the domestic flows, these are the ones that will continue to drive the Indian markets higher going forward. There was also some more research that came in, more opinion that came in from Gavinkel Research, and they also said that even if this Chinese rally sustains, a lot of foreign investors are still reluctant to invest there. The headwinds for China will become tailwinds for the Indian markets going forward, and it is too early to call time on this bull market in India. And lastly, a very important opinion coming in from billionaire investor Stanley Druckenmiller. He mentioned this at a conference a couple of days ago, and he mentioned that he has no interest in China as a market as long as Xi Jinping is running the country. So there's still yes, there is money moving out of the Indian markets into China, but not many on the street are convinced about it.
Okay, thank you very much for that. Prakash Diwan is with us. Prakash, we may not know what the FIs are doing, whether they're pulling money out of India and putting it in China. But what about Indian investors, people that you speak to, HNIs, retail investors? What are they up to in the last few days? Are they pulling money out?
Good afternoon, Rima. No, so I don't think there's any panic. The money that's being pulled out entirely seems like have belonged to the FIs. It's and of course, most of the investors in India don't have an option to go beyond India, beyond certain limited domain that they could participate the LRS money with. But my sense is the market needed a trigger to sell off. Why the selling has been a bit precipitous, is because FIs chose to do this in a very short span of time, just a couple of days, and you've seen this huge sell-off with very clearly the domestic side of the institutional market not buying everything which the FIs wanted to sell. For obvious reasons, because valuations are at a stretch. And I'm sure all of us know that if we get things at lower levels, the risk-reward turns very favorable. So it's a very healthy correction where the market seems precipitous. In fact, till some time back when I was talking to investors, they were worried about the global war and the geopolitical tensions in various pockets. But that seems to have got digested, though the tensions have intensified in the last 1 week. This seems to be a flow issue. So what brought money back to India and in a gush led to our indices crossing newer highs is also responsible for some of the highs being taken off. But from a investor perspective, HNIs, family offices, I think I've chosen the smart way to invest into businesses that have a slightly longer term orientation and salience, and possibly at the IPO, pre-IPO level, which means your price erosion chances are much less. So it's a lot of smart money that's investing in very smart ways now. I don't see any panic in the market at all.
Okay, well, that's a thought for sure. But as of now, we're still dealing with a pretty substantial decline that continues as we go on. Actually, talking about some of the movers and shakers today, and at least some of the stocks that have been in news, look at Mahindra & Mahindra Financial. That stock is down about 6.5% because one of the key issues was a slight deterioration in asset quality that M&M Financial reported. Prakash, hi, afternoon. Come in on the updates, and many have come through. I've just picked out M&M Financial because it's seeing an outsized stock reaction. Any thoughts on this one or any other update that stood out for you in the BFSI space?
Good afternoon, Surbhi. So I think the BFSI space will probably follow with a little bit of a lag in terms of how the banks do. And from all data points that we get from the banking side, at least, things are looking much better. Whether it's HDFC, whether it was PNB the other day. My personal sense is that NBFCs, especially the ones that have a quality portfolio and have never been challenged by quality of assets going forward, and by virtue of that, you count the Bajaj Finances, the Sundaram, the Cholas of the world. They are the ones to be with because, in volatile times, these are the ones that may go down. You may have drawdowns in your portfolio, but then they're faster to bounce back as well. So whatever you buy now will have to be very high quality for the simple reason that you will not see a lot of the not so great quality stocks probably struggle to do well. And that's going to be a very difficult situation if you have more of that in your portfolio. So from the NBFCs, I would believe, of course, M&M is, L&T Finance and M&M is something which I really don't, I've never recommended investing into these two. But I would look at Bajaj Finance for the simple reason that it's making a comeback, which is slightly long-term for me, but distinctly there. So from these valuations, you really don't have much of a risk except for the FI selling, which has already been absorbed, I think, in the last couple of days.
Okay, fair enough. Since we're on the subject, let's actually look at the granular numbers. Exactly what have these companies said in the second quarter, which the market is taking note of, both Bajaj Finance as well as M&M Finance. We have Abhishek joining in with all the details. Abhishek?
Well, to begin with, Bajaj Finance, the new loans are up 13.5% YOY, but they have declined more than 11% quarter-on-quarter, which is seasonal in nature. Every Q2, you do see a decline. Now, customer base is up 20.3% YOY and about 4.5% sequentially. The deposit momentum is strong at 20.5% YOY and about 5.5% sequentially. But the AUM growth now, that's dipped to 28.8% YOY, which is the weakest growth that you are seeing in last 6 quarters, and sequentially it's at 5.6% quarter-on-quarter growth, which is the weakest in last 9 quarters. Now, cross-sell rate, that's disappointed massively. It's the lowest in Q2 of a fiscal in last few years, X of Q2 FY21 when we had the COVID impact. So cross-sell rate is down to 6.2% versus 6.5% in the same quarter last year and about 7.4% in the previous quarter. With respect to M&M Finance, disbursements and asset quality have disappointed. So disbursements are down 1% YOY, but they are up 3.3% sequentially. The assets are up 20.3% YOY and about 6% sequentially. This may indicate that, despite lower disbursements, AUM growth has happened. That means the tenure of the, disbursements done in Q2 have increased. So if you take a look, gross NPA ratio is up at 3.8% versus 3.56% in the previous quarter. Liquidity in the balance sheet is about 8,500 crore, which is up more than 6% on a sequential basis. Back to you.
Okay, thank you. But also tell us a little bit about HDFC Bank. First, the Q2 business update. And also there seems to be more FI headroom now that, the bank has released their shareholding pattern.
Well, to begin with SDFC Bank, the business update that has come in, clearly the focus is on credit deposit ratio, and deposit mobilization has been pretty strong for them on a sequential basis. Take a look at the overall deposit growth of 15% YOY, but more than 5% sequentially. In that, the term deposit is up 19.3% YOY and about 6.7% quarter-on-quarter. Advances growth is muted at 7% YOY and about 1.3% sequentially. We have been hearing the news of sell down of portfolios of SDFC Bank, and that's led to weak loan growth. The overall AUM growth is at 8% YOY and about 2.3% sequentially. The heartening point in the number is the credit deposit ratio. That's declined to 100.8% versus 104.5% in the previous quarter. Even the liquidity coverage ratio has improved sequentially to 127% versus 123% that it was there in the last quarter. With reference to their shareholding pattern that's being released for September, FI headroom now indicates the second tranche may be coming in November MSCI review. So if you take a look, the SDFC September foreign ownership limit is now at 55.5% versus 54.8% that was there at the end of the June month. So weight increase of SDFC Bank is at the discretion of index manager of MSCI. Back to you.
Okay.
Thank you.
Okay, all right, Abhishek, thanks very much for that. I was just thinking it's the kind of market we're in, right? Because on any other normal day, say any day in September, because October things change, HDFC Bank coming out with, those kind of numbers, deposits picking up, the credit deposit ratio coming down, plus the fact that you'll have the second tranche of the sort of FPI money coming in, could have been a very different day for the stock. But right now, it's just down about 1%.
And the fact that these are selling, these are large, banks is where FIIs are more than anything else, right? So I think that shows that there is selling, which absolutely seems to be coming in. Prakash, any thoughts on on DMart specifically? And Mangalam will join in a little later, and we'll put those numbers in perspective as well. But trades at about, I think, 75 times FY26 earnings now. The peak was 170, 180 times 1 year forward. That was back in 2021. So valuations have moderated quite a bit, but your thoughts?
So, Prashant, what seems to have moderated is also the PEG multiple. When you talk about the peak PE multiples of 21, it was in anticipation of all the catch up that they were likely to grow along with, and they did. So, but if you look at today, given the fact that, the last minute, the last mile delivery and this hyper delivery, models that have come up, they definitely do impact DMart in a very indirect way. Let me tell you the second order impact. What does Zepto or a Blinkit end up taking away as market share in value terms may not be much, but it takes away the entire, potential of a customer to go into a DMart to stock up on, the entire range of monthly groceries or needs. And because they know that they have the comfort of ordering last minute. Now, what happens is that you don't make those frequent visits to DMart. I know families that have a very regular, twice a month, once a month kind of a visit, which is planned. And that probably is something which will start getting a bit questioned. And if that were to happen, your PEG multiples will not look as healthy. So I'm sure we'll hear Mangalam out in terms of the specific, metrics around it. But my sense is DMart will also have to get rationalized to some sort of thing. And remember, at some point, it's going to be part of the FNO, which means any bad news could also impact it much. So you really don't want a stock which is kind of getting into a territory where it gets vulnerable because of fundamentals and because of technical factors. So it's more ownership, intensity that's diminishing. I've seen a lot of institutions booking out of DMart for the last 3 months, and that will probably continue for some more.
What about Angel One? Angel One continues to see selling. It's down 31% from its recent high. At what point does Angel One become a buy, according to you?
Ariba, this is something which had grown. This is the equivalent of PSU order books driving stock prices. Angel One has grown on the basis of all the promise that it has, and rightfully so, for different verticals that it sits on, the technology platform that they've kind of evolved themselves into. I mean, it's a formidable money-making machine, but whether you want to discount it to that an extent or not is the question. Whereas demat accounts have grown to 17 crores, so when we spoke about Angel One and when the market started taking notice of it, sitting up and taking notice, it was probably about 12 crores. So market has grown. The organic growth of the market is fairly promising. But is Angel One got enough differentiators to build market share? Is a big question. And remember, the era of zero brokerage and all that is probably gone, is behind us. No brokerage will be able to afford that. So how much stickiness can they ensure in this changing environment is what people would want to see, and then probably give it a look. So I don't think the business model has transformed dramatically, Rima, but at some point you would want to kind of put in a little bit of a skepticism into the numbers, especially the valuations, and kind of take a more realistic look. And today, of course, the mood of the market is such you can actually put a dosage of skepticism into everything, and then still kind of find it very rational. So I think it's just that season of a reality check, but it could lose some more ground on the P multiple expansion that it has seen.
Yeah, absolutely. Prakash, take that point, reality check. And the market really remained true to its nature, because I think a lot of people would have debated around valuations, US elections, all of that, but perhaps nobody thought the correction, whatever little we have, would have come because China suddenly starts rallying. So once again, as the old textbooks say, that the only sort of fear is the unknown that you actually don't know. That's the only real unknown, right? So thank you very much for the perspective. Let's see how this settles and how we're placed by next week. But for now, the Nifty is dealing with a struggle around 25,000. We've dipped below that mark. And there's no let up in the selling, about 250 points lower on that index. Well, the India-China debate continues to be on, and today we discuss this with Alexander Redman of CLSA. He's the global equity strategist of CLSA, and we asked him about what he thinks about the rotation of money into China and perhaps away from India. Take a look.
What we've seen so far is a commendable delivery on the monetary policy side. We've seen some direct stimulus at getting the equity market animal spirits back alive, and certainly the retail investor has followed through on that. What will differentiate this one is if in the next weeks and months we get some clarity from the Chinese government, from the key policymakers in the Politburo, as to the magnitude and the scale and the deployment of a large fiscal package. Because let's remember, I mean, China's single biggest problem that it faces at the moment is immense oversupply on the real estate side. And you need a sizable fiscal package aimed squarely at local governments to be able to digest that. In other words, buy it off developers and turn it into social housing projects. India's been on a roll for several years now. You know, we've been a structural overweight. We've enjoyed that rally, but I've always been testing that because there is a certain amount of complacency around, or at least has been around the Indian equity market story, and a certain amount of consensus. And there are three things which I've been looking at to break that complacency. So you've seen regulatory changes which have dampened the ability of retail investors to participate in equity derivatives. You've seen the geopolitics in the Middle East become more of a flashpoint, and that's aggravated the oil price as we all sit now waiting for Israel's response to Iran's missile strike. And you've seen significant pickup in primary traffic. So the volume of IPOs and secondary issuance has picked up as well. So all three of those, I think, in combination, are certainly testing the Indian market.
Welcome back. Well, markets are down 260 points. 25,000 is gone. 24,992 is where now the index is trading at. It's a 1% cut. So it's turning out to be, I was seeing the 150 odd point bounce in the mid-afternoon. I was thinking, well, this is a good Friday, a good way to end after the bloodbath we saw yesterday, but no luck. For the week, Friday to Friday, if we end with this 240 point cut, Nifty is going to be down 4.5 odd percent for the week with a holiday thrown in between. I don't remember a 4.5% week on the downside in a long time now. So yeah, you basically have given back last 3 weeks worth of gains with what we've seen over the last 4 sessions now. Ajay Vora is with us, Head of Equities at Novama Asset Management. Ajay, good to have you here. Thanks for your time. I'm sure you're someone who follows flows and the color pretty closely in terms of what's going on out there. So tell us what's going on. Pretty much everyone we've spoken to, we've asked the flows question, and generally, if I can paraphrase without being too offside, it's that maybe in the very near term, a lot of the money which is leaving perhaps is being used to fund exposure to China, but it's like a week, fortnight thing. So with that preface to my question, tell us what you're picking up.
Sure. So good afternoon, Prashant, and thanks for having me on the show. So I think the bottom line, Prashant, is that markets are lacking any positive triggers. If you look at it, before the Fed cut the rates on 18 January, our markets were somewhere close to 25,000 odd, and everyone was trapped into that rate cut, on both the sides. So if you look at the positioning, HNIs were heavily short on index, and FIs were also not fully deployed as such, I would say. And that move led to FI increasing their longs, and eventually HNIs had to cut the short. So broadly, we got around 5 to 6% kind of a move post the rate cut, and now over last maybe 3 to 4 days, that has just got negated, right? So we are back to 25,000 odd levels. The point is that we are lacking fundamental positive triggers right now. And on top of it, you have two major, I would say, variable events which has come to the surface. One is on the geopolitical side, and secondly, the whole China angle. So, whenever the markets lack triggers, something of this sort comes to surface, it will result in a lot of uncertainty. The way I look at it, this is a really healthy period for the markets, I think, because if you look at it, since April till now, our markets are up close to 15% odd. And we are seeing, a decent earnings cut last quarter as well as this quarter. So my point is that, if the overall earnings growth, which was expected to be, say, 15-16% earlier, I think we'll end the year somewhere close to 10% odd. And versus that, we have a market which is already up 15% for the year. So I think it's important to consolidate here with some sort of, correction, more correction over next maybe couple of months. But I think that will be really healthy. Just to gauge, where exactly now the next trigger will come in terms of the sector allocation, and basis that, we'll see performance going forward. But I think this is a healthy correction. The China angle is definitely playing out, and that can continue. But that doesn't take away the earnings growth trajectory for India. So that's how we look at things.
So you're saying the earnings growth for FY25 is just going to be 10% versus estimates of 15-16% at the beginning of the year?
Yeah, so actually, if you look at it, Rima, last year we have ended at somewhere close to 980 odd. We started the year with somewhere close to 1130, 1140. That number is already down to, I think, 1090 or 1100. So broadly, we are looking at 10-11% now versus 14-15% earlier.
And how much will that hurt? Now, we've already seen about a 5% correction from the top. Now, in the last 1 or 2 years, we haven't seen even a 5% correction, or at best, it's been a 5% correction before a bounce back takes place. So if in the Q2 earnings, we continue to see some downgrades, do you expect downside in the market?
So I think it's important for us to change our habits also regularly. We should not get used to not seeing a 5% correction also in the market. So my sense is that, the whole sector rotation will continue. We saw, auto and pharma being the best of the sectors last year. And the earnings is still pretty strong, but the valuations doesn't leave enough room for upside. On the other hand, I think that if the rate cut cycle continues in US and that too on the aggressive side, I think the IT as a sector will continue to see some sort of order book building up, which will result in higher visibility of growth. So I think that IT and on the other hand metals, these two sectors are really well positioned from here on. Domestically, if you look at it, I would say banking is still a bit on the struggling side because on the unsecured loans we are going a little slow. On the NIM improvement also we are going a little slow. So I think that the banking, which is a very large sector, will have this overhang going forward. As I said, auto, pharma, they are more or less getting done, and therefore we need to look for different sectors which can take leadership. So markets can stay in a range, but as money managers, it is important for us to identify the next big opportunity.
Ajay, hi. Afternoon. You're the second guest today who's pointed out a sense of complacency. In the morning, we were in conversation with Alexander Redman of CLSA. That's exactly the point that he was making, that the Indian market perhaps is getting a little complacent. It reminds me of a dialogue from an OTT serial which played a couple of years back, and that dialogue went in Hindi कि अपन को लगता है कि हम ही भगवान है, right? So I guess it tends to happen. That's what bull markets do to you.
Like small, not hum, apun. What is it?
अपन को लगता है मैं ही भगवान है. If I could, I'm taking the liberty because it's a Friday, right? Eventually we'll go back and have a good weekend. So exactly, I think everybody's guessed which particular series this was. But yeah, I think that's what bull markets do to you, right? Because the whole valuation chatter was being cast aside because prices were moving higher, because liquidity was so heady. So therefore, your point is well taken, though the bulls may not actually like it right now. Okay, let's talk about Q2. You gave us the earnings projection for the full year, but the here and now, because we're running into the season and the litmus test is upon us. The board exams are here. Where do you see the biggest, perhaps, pain points? What should we be prepared for, where probably there would be a disappointment, and maybe earnings projections will have to be revised downwards, and maybe stock prices will need to move down as well in Q2?
So I think that, still on the growth side, IT will see, the numbers to be muted. But the point is that, that whole narrative is behind us, and people are more looking towards the incremental growth or the expectations of further order book buildup going forward. So I think that more than numbers, the focus will be on how the TCV actually shapes up over next 2 to 3 quarters. On auto, also actually, if you see that, this is the start of the festive season, and we will see some sort of inventory buildup, and therefore the numbers have been good. Raw material prices were a bit lower, and therefore the margins will also continue to remain good on that particular front. But I think that overall, if you look at it, a major disappointment last quarter, which was from OMCs, oil marketing companies, that will not continue in the current quarter because of the healthy marketing margins which they made in this quarter. So my sense is that overall, you will not get a major disappointment anywhere. But the point is that, the 13, 14, 15% expectation is slightly getting pruned quarter after quarter. And once, market digests that this year it's not going to be double digit and it can be maybe 9-10%, we can see some sort of further pullback on the markets. So I think no major negative surprise as such is what we are building.
All right, fair enough. Ajay, we leave it there. Thank you very much for joining us, and good perspective as always. Have a good weekend, and we'll come back next week maybe with better tidings, better news, and better markets as well. But for now, we're down a little over 1%, actually 1.1, 1.2% at this point in time. Before we take that break, maybe I can just put out, this is an interesting bit on geopolitics, markets, oil, Iran, Israel, etc. And this is coming through from Christopher Wood, who writes the greed and fear note at Jefferies. And I just want to read some of this out because I found it interesting. Maybe you will as well. He says Israeli Prime Minister Netanyahu is continuing to take advantage of an ineffective power vacuum in Washington, which is fast changing the balance of power in the Middle East. Second, he says Iran has finally been provoked into a response which seems to have been the aim of Netanyahu all along, lays the groundwork for further escalation. Number 3, he says it's no surprise that Netanyahu's popularity is soaring in Israel, which is likely to give him further confidence to continue on his current path. Number 4, he says, the risk for markets, and he comes to markets now, he says, is that Israel attacks Iran in a more direct fashion and that the Iranian leadership finally decides to respond in a more telling way by, for example, closing the Strait of Hormuz or attacking US military facilities in the Gulf. So that's the escalation, and that's the one which is which markets, according to him, will react to, and they're not prepared for as of yet. As he goes on to add, he says that as for sort of weighs in with the US elections as well. He says, as for Trump's view on what's happening in the Middle East, Trump has always been solidly pro-Israel. Still, Trump does not like wars, and he's intrinsically unpredictable. This is a further reason for the Israeli PM Netanyahu to use the current power vacuum in Washington to advance his agenda as much as possible. And then, he sort of winds down with a bit on China as well. He says valuations in China have moved up. MSCI China is now trading at 11.5 times 12-month forward earnings, which means that it's no longer as cheap as it was when this rally began, and hence markets there are vulnerable if the recent easing measures do not succeed in triggering a re-acceleration in nominal GDP growth. And he says the recent easing package in China and the market's dramatic reaction is further reminder that the policy in China is essentially now made by one man, that is President Xi. So I just thought, interesting bit coming through early this morning from Christopher Wood on, of course, some of the hot button issues that we're looking at. We'll take a break. We'll also just leave you with the soundbite coming in from a large foreign investor, head of multi-asset at Wantable Asset Management, Dan Scott, talking about his top choices as far as portfolio allocation is concerned. Listen in.
Well, gold, we've been overweight for a few years now. So, we're holding on to that one because we still think that the structural long-term drivers are in place, that central banks outside the G7, not just China and Russia, but also India, South Africa, etc., continuing to stockpile gold. It's a long-term de-dollarization story. And de-dollarization is another part of the conviction that we have longer term. Another way, of course, that we play it is the long-held overweight that we have in emerging market debt. The compensation I'm being given through the high yields in EM debt are, definitely rewarding, much more rewarding, I would say, than the compensation I'm giving in the risk I take in high yield, for example. So in the fixed income market, EM debt overweight is another one of our convictions that we're holding on to. The CSI is one of the better performing markets now year to date. So it's gone from being the market that everyone hates, no one wants to own, to all of a sudden, everyone trying to jump on this bandwagon. But I would say at this point, it's still a trade because the stimulus measures were impressive, no doubt. Also with targeted measures for the property market, which is the most important part of the problem set that China has that needs to be fixed. But property prices haven't, gone up yet. And in fact, the stimulus measures really are there to provide some sort of a floor to property prices. But I would say if you want to see the Chinese consumer come back, you need property prices to go up, not just to be stabilized. And that in combination with all the problems you already know about, demographics, 20% youth unemployment, etc., governance issues as an equity investor, would mean that right now it's a trade I'm happy I'm going to miss out on.
Welcome back. It's bounced back above 25,000, but still down, more than 200 points on the Nifty. Zomato is holding up in the green today, so that's up 2.5%. Paytm is down, under pressure, 4.5% low on Paytm today. But for the week, it's still going to close with gains of about 3.5%. And in banks, it's Bank of Baroda, Yes Bank, PNB, SBI, where there is still some green on the screen. But let's go across now to Nimesh for D Street Chatter. Nimesh.
Hi, Rimaira. Today was a classic day of two halves. The first half was quite good. We saw a good recovery as well. And even in the first half, the indication was the FI selling is not that large. But all that changed in the second half once Europe opened, because I understand there was a very large basket selling at a leading FI desk. And that's the reason why you're seeing big pressure again in the large cap names today. The biggest pain is in the rate sensitive. So the real estate stocks are under pressure. So is auto names, so is the bank names as well. So that's one pocket which is seeing a big aggressive selling. And OMCs are still under pressure because the crude has again rallied back to 78. So those pockets is where a large selling seems to be. Metal seems to be in a sweet spot. So even in a weak market, there is buying interest in metal names. So there is delivery-based buying happening there. But within financials, again, we saw a bit of recovery in the intraday, but that got sold into. And again, I understand there is aggressive selling in the private bank names by larger FIs today as well. On the Nifty, we've broken some crucial support levels. So the next level on the downside to watch is around 24,600 to 24,700 level. So that's something to track. But I guess all change in the second half on the back of an aggressive basket selling at leading FI desk.
Okay, we'll watch the flows figure very closely. What about stocks, Nimesh?
Well, even in a weak market, there are some stocks which are buzzing in trade. The first stock is Healthcare Global. In a weak market, that's up 5%. The volumes are on the higher side. Looks like the city is anticipating a large corporate development very soon. Remember, for a very long time now, there has been an anticipation that the P holder or the P promoter is looking to sell its stake. So that's something which can come very soon. So that's a trigger as far as Healthcare Global is concerned. The second name is BF Utilities. Even that stock is buzzing in trade for the last 2 days. The stock is up 10%. The volumes are on the higher side. I understand a leading influential HNI investor is an aggressive buyer in BF Utilities of late, and hence a big up move there in a weak market. Third, DLF and Macrotech. While the real estate basket is under pressure, DLF and Macrotech stands out on back of very aggressive selling pressure from leading FIs in today's market. And the last is Indus Tower. The stock is in the red, but for the second day running, there is buying interest from larger FIs. So expect high delivery volumes, but those are largely on the buy side.
Healthcare Global, BF Utilities, DLF, Macrotech, and Indus Tower as well. Nimesh, Healthcare Global, I mean, is that the deal where the PE was getting out, right?
That's right.
That is still it's still in the works, because it's been, I think it's been at least a few quarters now, right?
Oh yeah, exactly. In almost 3 quarters now that the buzz was there that CVC wants to exit. Looks like it's in the final stage now. I understand a couple of private equity investors are in the final stages. So looks, again for Healthcare Global, Prashant, while we all know that CVC is a likely seller, what is going to be more interesting is whether the Indian promoter also sells out. CVC owns 60%, Indian promoter owns 10%. If the entire 70% is sold, then there is a potential open offer and a potential delisting offer as well. So we don't need to speculate on the delisting part. But I guess that's something to track. If both Indian as well as the PE investors sell out, then we need to see how things pan out, because 70 plus open offer would virtually mean that there could be a delisting as well.
No, that's interesting that this is, in a way, just speaking, one was hearing that maybe it's not really going anywhere and some of the bidders have backed off, but interesting that it's as you're saying, well, you're picking up that this is happening and maybe in the final stages. We'll see. I remember asking the CEO of the promoter of HCG whether they prefer to have a hospital company or another investor instead of CVC. They said, well, we'd prefer a financial investor and not a hospital company there for that CVC stake. Thanks very much, Nimesh, for that. So that is, a few stocks there to keep on the radar. Ashish Kyal is with us with what to buy or sell today for a reverse trade when we come back on Monday. Ashish, what do you have?
See, if you look at it's going to be buy and sell both because the markets are not looking good. 25,000 is flirted around. We are managing to move far that above it again, but it looks little tricky. Having said that, I think the one stock which is outperforming in this kind of market also is Whirlpool. You can clearly see touching that 52x high. Even today's session, there is absolutely no impact of the broader sell-off that we are seeing in the mid cap and the large cap names. And so one can create long positions in Whirlpool. Maintaining a stop loss of 2290 and expecting a target of around 2520. And the other stock is going to be on sell side. It's a reversal trade on Piramal Enterprises. We can clearly see the stock has broken below the support level. There is absolutely a carnage over past 2 days in the stock also. So one can create short positions here, more room left on the downside, expecting a target of 970 and stop loss can be maintained at 1065 levels.
Okay, thank you very much for that. Let's revisit some of the big movers of the day. On the way down, it's Avenue Supermarts following their Q2 business update, where growth appears to have slowed down. Mangalam joins in for details. Mangalam.
Well, 14% growth is what the company has reported in the second quarter, which is lower than, the 3-year average as well. And at the same time, the last quarter, which is the first quarter, they showed revenue growth of about 18%. So it's lower than that as well. And if you add to the fact that over the last 1 year, the store addition has been around 12.2%, that leaves you with same-store sales growth of just about 1% or 1.5%, which is much lower than what we've seen in the past couple of quarters as well, which is why the street is a little disappointed. The only 3 possible reasons that one is gathering in terms of reasons for this slowdown in growth. The first one, of course, is that there were heavy rains and some flooding in parts of Maharashtra as well as Gujarat, which are bigger catchment areas for these companies. So as a result of which, footfalls were lower. The second major reason is that there could be a back-end technical change that the company has been doing, as a result of which there were a few days of lost sales as well. And the third reason, of course, which everyone's intuitively talking about, is the impact of Q-commerce. The extent of either of the 3 is not entirely visible. So we'll keep an eye out on gross margins and the performance of their own Q-commerce business when the company reports its numbers next week as well. Until then, we'll keep an eye out on DMart, which is seeing a lot of volume activity today as well in on the downside.
Okay, thank you very much for that. We will get into a break. We'll come back with more.
A large down day once again. If you thought that yesterday was bad, well, today was not worse, but it didn't give you any relief whatsoever. The market ended down about 200 points lower on the Nifty, which means for the week, the market, by the way, is down a little over 4%. I think it's the worst week we've had since the beginning of the year. The Nifty Bank had it much better. It was down just about 0.5, 0.6 odd percent. All right, Gurmeet Chadda is now with us. Welcome back. Markets down 200 points or so, and we're having the worst week we've had since the beginning of this year. Gurmeet, good afternoon, and good to speak with you. Tough markets. What does one do, Gurmeet? You got to. I mean, to enjoy the good, you got to go through the bad as well sometimes, right?
Oh, absolutely, Prashant. And, I think all three came together. China's stimulus came, Iran-Israel escalation came, and you saw the heavy tightening of rules. I think you've got to differentiate now. I think this particular FI sell-off is more tactical. It's not structural. It's largely led by the China stimulus. And just to give a perspective, China 30% GDP is real estate. 70% savings of Chinese go to real estate. So any stimulus which affects the reality market will attract attention considering the large underperformance, almost 10-year, 15-year underperformance. So I don't think so this is structural, which means, and I've always said, whenever India falls for non-India reasons, it's an opportunity. Where we need to now focus upon is that some of the updates have been soft, like the auto updates, the services PMI also was a tad soft. The capex is slowed down. The government capex, if you see, we will undershoot. Defense budget, they've underspent 20% so far. Road, they are underspent 35%. So I think that needs to go up for things to pick up. So you got to be now selective in terms of what you want to buy. But I don't think so. I think bull market corrections are also sharp, and so is this one.
Anything you've done for your clients, Gurmeet, last couple of days?
Yeah, so we've been adding large caps like Reliance, Tata Motors of the world, few banking stocks. We've added some PSU banks because they are below book value. Bank of Baroda had a very good quarter update. Retail deposits grew 20%. You have to track deposit growth now because RBI is very keen on credit deposit ratio at about 85-90%. So deposit growth becomes, especially the granular one, becomes good. We've added Federal Bank there. We're adding some quality NBFCs and banks will also have a lot of treasury gains. The 10-year bond yields are down almost 30 basis points from, let's say, June till now. We've added some names in defense with this current fall. We are adding to build some more names in the recycling space, which is in plastics, in water, in lead, etc. And we are now scouting for a little bit more opportunities in data center and the telecom value chain.
Okay, all right. Gurmeet, I think we'll have to start winding up over there, getting to the close of what's been a really trying week for the market. Thank you so much for joining in. Well, as we start the final countdown, the cut is about 208 points on the Nifty, and for what it's worth, at least the index has managed a bit of a pullback. I've been saving grace that the close is going to be above the 25,000 level. Now, that's the Nifty. The mid-cap index has actually fallen in step with the Nifty today. Again, a cut of about 0.9%. Bank Nifty is relatively better off. Let's talk about where the damage was most apparent on the index. On the large cap screen, M&M, Bajaj Finance, Nestle, BPCL, Ultratech Cement. These are some of the weakest performers, and you can see it's just cutting across sector lines. There are really no trends today, just top-down selling. A lot of consumer names actually have come under pressure. Asian Paints, Britannia, I mentioned Nestle earlier, Lever, Cipla, no hiding in consumer or in pharma for that matter. On the flip side, a little bit of buying on IT, Infosys, Wipro, Tech Mahindra, and TCS. These are the names that stood out. And the reason why we're managing a close above 25,000 is probably because names like SBI, TCS, they were putting up a bit of a fight. And of course, Infosys was the best performing stock, 1.5% on the upside. But, well, what do you say? For the week, we're talking about the Indian market losing, I think, just about 4% on the Nifty. Let's check the final levels. So, yeah, it is a 4.4% drop. And I think Hormaz was earlier telling us this will be obviously the worst week for the year, and probably over the last 1 or 2 years we've not seen a 4.5% kind of drop at the index level for quite some time.
Cuts across the board, right? I mean, as far as large caps, etc., are concerned. So I'll just tell you, in terms of the Nifty pack, Mahindra & Mahindra was the top loser with a 4.5% knock coming through. Bajaj Finance was down 3%. Nestle lost about 2.33%. Asian Paints was down 2.25%. BPCL was down 2.5%, and Hero MotoCorp was down about 2.25% or so as well.